Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Blackrock. Last, they generated a revenue of $19.37 billion. They have a market capitalization of $106 billion, and they can be found in the investment banking sector. The revenue also comes to 100% from the investment management. The revenue of Blackrock can also be divided geographically. 65% comes from the Americas, 31% comes from Europe, and the last 4% comes from the Asia Pacific area. Now I'm going to determine how much I should pay for the stock. The key matrix I use to calculate the fair value and my buy price for Blackrock is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I'll take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.48%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from the ideal straight line by calculating the relative standard deviation, which for Blackrock is 8%. To the historical yield, I add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. From this value I get information about how much the dividend yield differs from the reality. A high relative standard deviation will higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Blackrock is 8%. This value is just inside the green section of my weighting scale. Therefore, I'll subtract 5% from the margin of safety. As a dividend investor, the dividend growth plays a huge role for me as well. In 2011, $5.50 were paid, and in 2022, $19.52 is expected. Blackrock has not decreased the dividend for 18 years, and they've increased the dividend for 12 years in a row. This actually makes them a dividend contender. In the last 5 years, the average dividend growth was 14.31%. And that's not bad. Therefore, I'll subtract 10% from the margin of safety for the dividend growth. By looking at the payout ratio, I'll find out if this high dividend growth is healthy for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Blackrock increased from $2.63 billion in 2019 to $4.6 billion in the last 12 months. The cash dividend were respectively $2.7 billion and $3.3 billion. The average payout ratio is therefore 66%. This value is inside the yellow section of my rating scale. Therefore, the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $8.42 billion and they have $7.36 billion in cash. when the cash gets subtracted from the debt, and this value then gets divided by the EBIT, the debt to equity ratio is found. The EBIT is currently at $7.87 billion, which leads to a debt to equity ratio of 13%. This value is really good, and Blackrock could basically pay off the debt at any time if they wanted to. For this very good value, I'll subtract 5% from the margin of safety. Last, I'll take a closer look at how the business is going. The revenue has increased from $12.49 billion in 2017 to $19.37 billion in 2021. This gives an average growth of 11.6%. In the same period of time, the EBIT increased from $5.51 billion to $7.87 billion, which gives an average growth of 9.3%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 44%, and in 2021 decreased to 40.6%. The margin therefore decreases with 2.6% in average each year. An EBIT growth of 9.3% is in the light green section of my weighting scale, which gives minus 5%. A decreasing margin, on the other hand, is not a good sign, and for an average decreasement of around 2%, I'll add 10% to the margin of safety. Since every matrix from my analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the relative standard deviation, minus 10% for the dividend growth, minus 5% for the debt, minus 5% for the EBIT growth, and plus 10% for the margin growth. The new margin of safety is therefore 10%. This leads to a desired dividend yield of 2.73%. By a current dividend of $19.52, I should therefore don't pay more than $750 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Blackrock is $787. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield line. This then gives a new line which always lies 10% over the yield line. As seen in the graph, the historical yield line and the margin of safety line is under the yield curve. Therefore, I consider the stock as undervalued. Finally, I consider the stock at its fair value when the price is $787. I will buy the stock at $715, and the stock price is currently at around $700. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for weekly content.